Mainstream economists and finance practitioners, please check your premises. You have contradictions before you.
Because we started Vanguard in 1974. And everybody.
I know what you're thinking, but let me explain in the studio. I know what you're thinking. Isn't Irene all about index fund investing? Yes, I love index funds. A good chunk of my own investment, actually more than 70% of them, are nested in these funds. So this isn't a video that I turn my back on them. Index funds has been a fantastic vehicle for many of us, but I think it's crucial to zoom out and see the whole picture. Can we really say they are the ultimate hassle-free investment solution? In this video, we'll uncover some angles of index fund investing that don't always make it to the headlines. We'll talk about the good stuff because there are plenty, and we'll also shine a light on the not so great parts. All right, let's break it down and talk about what exactly an index fund is. Imagine this, I decided to collect some money from you and you over there too. We put all that cash together to buy a bunch of investments. And this could be anything from stocks and bonds to real estate or even private equity. Now, as the one managing this big pot of money, I've got some rules on what to buy or sell. Let's say we only scoop up tech companies that are big shots with at least 1 billion in market cap, rocking a current P/E ratio of 20 and have been pulling in net margins of no less than 15% of the last 5 years. Yep. I just made that up. But if I did that, managing our collective investments according to those rules, you call me the fund manager and you'll be rocking the title of mutual fund investor. Now, on to the next bit. What's an index? Think of it as a giant scoreboard that keeps track of how a specific group of assets is performing. Sounds a bit abstract, right? Let's get real with an example everyone knows, the S&P 500. This index includes the 500 biggest companies listed on US stock exchanges. Why 500? Well, that was the magic number chosen by its creators, Standard & Poor's. As of March 2023, there were about 6,000 companies trading on NASDAQ and New York Stock Exchange combined, so this choice of 500 allows the index to cover all the major sectors of the US economy, giving us a neat snapshot of the market's overall vibe without getting too complicated. Imagine the index as a mega hit playlist with 500 chart-topping songs. You can't own the playlist itself, but you can buy a CD that is your index fund, which has all those hits. Each index is like a different genre of music playlist, measuring the market's rhythm in its own unique way. The S&P 500 is like the greatest hits album of large cap US companies, a solid indicator of the market's health. The Nasdaq 100, picture this as the ultimate tech and biotech playlist, showcasing the 100 largest non-financial giants on the Nasdaq, is the go-to for tech vibes. And the Dow Jones Industrial Average, or the Dow, think of it as an exclusive clubs playlist, only featuring 30 major hits from the significant US companies, as one of the oldest market indices is like the classic vinyl record of the US stock market. Then what is the difference between an index ETF and an index fund? Are they just twins going by different names? Not exactly. An ETF, exchange traded fund, is an innovative structure of the traditional mutual fund. With an ETF, you get to buy and sell shares of it just like you would with any stock, anytime the market is open. If an index ETF and an index mutual fund are both chasing after the same index, the stuff you own, the actual investments inside, should look pretty much the same. It's like the two chefs following the same recipe but serving it up in different styles of dishes. One big drawback of an index ETF is that they're so easy to trade that it might tempt you to buy and sell way more than you should. But hey, if you're all about that buy and hold, you're likely steering clear of that trap anyway. And their management fees are relatively cheaper, therefore higher returns in general based on the research that I did before in this video. So for the sake of simplicity in this video, when I say index funds, I meant both traditional index mutual fund and index ETF. Ever since John Bogle from Vanguard brought the first index fund into the world back in 1975, it's been like watching a rock star rise to fame, especially among folks in the FIRE community, that is financial independence, retire early. Last I checked, in mid-2021, a whopping 11 trillion was riding the index fund wave globally. And leading the pack, the Vanguard Total Stock Market Index Fund, VTSAX, boasting 1.5 trillion under its belt. So why the fanfare? Let's lay out the highlights. First of all, it provides instant diversification. Picture an index fund as your investment smoothie. With just one sip, or in this case, one share like VTSAX, you're getting a taste of 3,750 stocks It's like holding a little piece of thousands of companies across various sectors, spreading your risk thin. And the best part, you don't have to play mixologist and rebalance your portfolio when the market shifts. The fund manager keeps your investment recipe in line with the index. Number 2, index funds expense ratio is typically very low. Since there's no need for a fund manager to play fortune teller and pick stocks, the costs are super low. We're talking about fees as tiny as 0.015%. To put that into perspective, that's way lower than the average fees you'll find in other investment options. The average annual fee charged by a US retirement account 401k is 1%. In Australia, the average fee in superannuation default investment option is parting between 0.91% to 1.21%. Number 3, simplicity. Index investing doesn't require extensive market research or stock picking skills, as you are buying in the entire measured market. It's simple, straightforward approach is very beginner friendly. On top of that, many index funds offer automatic reinvestment of dividends and auto investing, making it an ideal investment for a set and forget strategy. Next is transparency. With index funds, what you see is what you get. They measure the index they track, so you always know exactly where your money is and how it's weighted. Another benefit is tax efficiency. The buy and hold strategy of index funds will not only delay the capital gain tax naturally generated by the companies, but also minimize the internal capital gain tax compared to an actively managed fund, which is the frequent turnover due to active managers' attempts to outperform the market. The last one is performance consistency. This might be just the cherry on top. Investing in an index fund means you're riding with the market's average return. As I mentioned before, more often than not, active funds struggle to beat the passive index funds over the long haul. So you're probably thinking, index funds sounds pretty great, Irene, but what's the catch? Well, as with anything in life, it's not all sunshine and rainbows. Let's talk about a few hiccups you might face with index fund investing. Number 1, the reality check. You won't get rich quick. First off, index funds are about playing the long game. They mirror the market, which means you're signing up for the average market return over time. Historically, the S&P 500 has given us about 10.54% return annually over the last century, dividends included. Adjust for inflation, and you're looking at 7.4%. Using the rule of 72, doubling your investment with an S&P 500 index fund could take about a decade. For those dreaming of overnight riches, this might feel like waiting for paint to dry. Now, I often referenced the Spiver scorecard to highlight how well passive index investing stacks up against the active approach. But here's the twist. While a significant chunk of active funds don't beat the market over time, there is a small percentage that does. Let's take the Australia Equity General versus S&P ASX 200 index. If we look at 3-year absolute total return before fees, 57.43% of the active mutual funds underperform the index. As we expand the investing horizon, more active funds are failing the task. A 79.14% underperformance rate also means that 21% of active funds did beat the market index. You can go down this path to earn the actual returns, but the tricky part is how much more return can you get out of the active funds? This scorecard only tells us how many active funds outperform without any return records, and how much would the fees of the star active funds be if I could only get 0.5% more return, but the fee cost me 0.45% more. I would rather stay with the passive index fund because it takes time for me to find them, and when I finally discover them, invested, I don't even know when our relationship is gonna end, because the longer my money is invested, the more chances my fund would disappear. The 10-year survivorship of the Australian Equity General Fund is 61%. So yes, while passive index investing might not be your ticket to becoming an overnight millionaire, venturing into the world of active funds is no walk in the park either. Index funds are like a set menu in a restaurant. What you see is what you get. You can't make it more salty or spicier if you wish. You get a slice of everything on the index menu, whether you like it or not. While this simplicity is their strength, it can also be a limitation. You own a small piece of each company regardless of its performance or future potential. This diversification is great for reducing risk, but it also means you can't capitalize on individual growth stories. Your investment is diluted across many companies, including both outperformers and underperformers. You won't lose big, but you also won't win big. Another drawback is overexposure to market giants. Most indices are weighted by market capitalization. This means the bigger the company, the more of it you own. Over time, your portfolio might become heavily skewed towards a few market giants, potentially exposing you to unforeseen risks if these giants stumble. The concentration of your investment in overvalued stocks is potentially undermining the fundamental principle of buy low, sell high. There's an easy fix to this, that is to buy the same index fund following an eco-weighting methodology. For instance, Investo S&P 500 Eco-Weight ETF, RSP, in the US, BetaShares S&P 500 Eco-Weight ETF, QUS. However, they typically charge a higher management fee due to more frequent rebalancing. Another problem is the illusion of diversification. Index funds are celebrated for offering instant diversification, but this can also be a double-edged sword, especially in market downturns. Broad market index funds are subject to systemic risks, meaning things like market corrections and black swan events can all affect the index fund's performance. Although individual stocks cannot mitigate systemic risk entirely, a well-considered selection of individual stocks can help effectively defy market trends due to the nature of the company's products, company's specific news, or performance during tough times. Sure, picking individual stocks is like choosing your own adventure, potentially steering clear of those waves, but it's a journey with its own sets of maps and monsters. And lastly, we're gonna discuss a rather serious topic. Are passive index funds in a bubble? Let's first look at Michael Burry's pessimistic view about passive investing. Michael Burry is best known for being among the first investors to predict and profit from the subprime mortgage crisis that occurred between 2007 and 2010. The movie The Big Short is his story. He shorted the 2007 mortgage bond market by swapping CDO and made a personal profit of $100 million and $700 million for his investors. Michael Burry has long been a critic of passive investments, and in 2019 he publicly exposed his opinion on another bubble that has been shaping for well over 25 years. And this time he referred to the index fund. He cited a very interesting academic paper written by researchers at Harvard and the University of Chicago. The paper, In Search of the Origins of Financial Fluctuations, the Inelastic Markets Hypothesis, discussed several topics in depth. The most relevant to our topic is they found that, quite contrary to the Nobel-winning efficient market hypothesis, which is widely used in modern finance and literature and has been cited as one of the primary factors that led us to the global financial crisis, that markets can be inefficient, or in other words, inelastic. Efficient market hypothesis suggests that stock prices fully reflect all available information. In an efficient market, prices adjust quickly to new information, making it impossible to consistently achieve returns in excess of average market returns on a risk-adjusted basis. From this perspective, the market could be considered elastic because prices are highly responsive to new information. Michael Burry was pretty much in the camp of the inelastic markets hypothesis. During his speech at UCLA in 2012, he said,
As it turns out, information is not perfect. Volatility does not define risk. Markets are not efficient. The individual is adaptable. But the dark ages of finance allow no such light. Mainstream economists and finance practitioners, please check your premises. You have contradictions before you.
So what these researchers found that investing $1 in the stock market increases the market's aggregate value by about $5. A significant degree of stock market fluctuations are caused by flows rather than by traditional securities analysis. Based on this theory, the only way to cool down the overvalued market is to get cash flows out of the system. If this hypothesis is true, 90% of millennials, aka future wealth owners, are in passive market vehicles. That 5:1 ratio would get much sillier in time. So, are the current index funds or broad market indices overvalued at the moment? There are a few key metrics experts like to use to figure this out, so let's break them down into bite-sized pieces. Let's look at the important metrics: CAPE ratio, also known as Shiller-P ratio after Nobel laureate Dr. Robert Shiller. Imagine you're trying to figure out if a slice of pizza is worth its price, not just today, but considering how good it's been over the past 10 years. That's kind of what the CAPE ratio does with companies in the S&P 500. It looks at their current market price versus their earnings over the last decade, adjusting for inflation. The higher this number, the more investors are currently paying per dollar of actual earnings, more likely our investment returns are likely to be lousy and sideways over the next 10 to 20 years. And Dr. Shiller found out a pattern that whenever the Shiller PE was over 25, the market return over the next 20 years was negative. More recent analysis using shorter 10-year period have shown similar results. When the Shiller PE of the market is over 25, the rate of return over the next 10 years varies between about 8% at best or minus 4% at worst. Next, we have the Buffett Indicator. Well, he once said this ratio is like the stock market's thermometer. It compares the total price tag of the stock market to the country's entire economic output. Historically, the average ratio is around 89%, but lately we're sitting above 100%. According to Buffett, that could mean the market's running a bit hot. Now, let's look at the passive ownership. Some folks might say, hey, index funds just a small piece of market pie. How could they cause a bubble? Well, a recent study popped the lid on that argument, showing that passive ownership through index funds might be closer to 37.8% of the US stock market as of 2020. And that's just the minimum estimate. They argue that this number is a low bound. The true share must be higher. Alright, so we've crunched the numbers and both the CAPE ratio and the Buffett indicator hint at a market that is pretty heated right now. And if nearly 40% of the market is tied up in passive funds in an efficient market, the market should adjust or absorb this high valuation situation. Well, again, what if the inelastic market hypothesis is true? The market cannot adjust to overinflows, which cause the inflated overvaluation, and the only reverse action is to get the outflows going. So, what's a passive investor to do in times like this? Let's hear the father of passive investing, Jack Bogle, has to say.
Well, number one, if everybody indexed, the only word you could use is chaos, catastrophe, whatever. There would be no trading. There'd be no way to convert a stream of income into a pile of capital or a pile of capital into a stream of income. The markets would fail. Now, what's the chance of everybody indexing? It's zero.
Do you have any idea what percent it becomes dangerous?
And I think you could easily be at 75% and not have it become dangerous. But dangerous in what sense? The markets are going to be efficient as long as they're managers or investors who are trying to find little holes in the system and create value, discover value, price discovery as they call it. And so I don't worry about that. And I meant not to be too negative about it, but it's certainly not going to happen during my lifetime.
Well, he definitely highlighted the dangers of everyone jumping on the same investment bandwagon. I agree with Bogle that if the market is not efficient, which means there are opportunities to earn alpha returns, we would eventually see money moving towards investment that truly seek value, whether that is for savvy institutional players or individual investors doing their homework. My take? Following Bogle's lead, I see passive index funds as the steady, reliable workhorse in my investment stable, simple, straightforward, and geared for the long haul. Yet, I can't help but keep an eye out for those undervalued gems that not yet sparkling in the index fund spotlight. Index investors, what should you do? Let's keep the conversation going. Drop your thoughts and questions below. My name's Erin. I'll see you next week. Happy investing. Bye.